chapter 4, verse 1 and 2, saying that finances is not a set forgiveness. Hey there. Welcome to the Radical Godly Stewardship Podcast. This is the place where heaven's economy collides with Earth's assignments. And I am your host, Dr. Lexi Johnson, your financial rebel, your kingdom disruptor, and your accountability coach into obedience. Because around here, we don't beg God for money. That's not what we do. We align, we obey, we produce, we multiply, and we dominate. If you're ready to steward well, think boldly, and build kingdom wealth, then you are in the right place and we are getting ready to dive in. Welcome, welcome, welcome. As you're coming in the room, we would love it if you let us know who you are and where you're watching from so that we can acknowledge you. Today, this is episode number 60. Episode number 60, and we're talking about protecting income and positioning for the next cycle. And we're going to do that by talking about tariffs, by talking about the credit card caps, possible credit card caps, and market moves. Okay, that's what we're talking about today. You know, in the last few days, we have seen a proposed credit card interest rate cap, right, aimed at protecting consumers. But, I don't know. There's some potential downsides to this as well. We're going to talk about it. We are going to talk about it. Hey, Amanda, good afternoon to you. And we're also going to talk about this major market reaction, okay, to some geopolitical news, an announcement that took place yesterday, which was specifically this framework deal with NATO on Greenland, right, that led to the market just spiking, right, after the tariffs were pulled back. So we're going to get into that and talk about that as well. And so, what are the questions that we're answering today? Wait, this is not our stewardship check in yet. I'm just sharing with you what questions we're answering as we go through our episode for today. And the first question is what the credit card rate cap could mean for your access to credit. We're answering why the stock market jumped after the Greenland NATO announcement. We're also answering how this impacts everyday people, not just investors, right? Because this is what I'm trying to teach you here, that every decision that is made, just about every decision that is made, even on the federal level, right, has something to do with your pocket, okay? And then, of course, we're going to be talking about what kingdom citizens should do to protect their income and position themselves for the next cycle. All right. So before we do that, we're going to do our stewardship check-in as we always do. Now, this is the part of the podcast, the part of the broadcast, the program, or whatever you want to call it, the show. This is the part where we go deeper and we check in with ourselves. So I typically ask you some questions and they can be rhetorical or you can, put them in the chat if you're bold enough. And I always say for those who are bold enough, thank you, because your answers often help other people, right? You never know how your answers can help other people, to help them, maybe there's a tip, maybe it helps them to not feel alone, all of those things, right? Hey, Crystal, good to see you this afternoon. So here are our stewardship check-in questions for today, all right? Either answer them to yourself or feel free to put your answers in the chat. Now, question number 1, do headlines move your emotions or your strategy? Do headlines move your emotions or your strategy? So, good question. It's one that we should often be asking ourselves because there's all kinds of headlines on a daily basis from morning until night. There are headlines, right? And I have been teaching you all here that when it comes to building wealth, we cannot move by our emotions. Okay. We cannot move by our emotions. We have to listen to the headlines and then determine whether or not we already have strategy in place that will manage that, or if we need to put strategy in place to manage it, right? Question number 2, do you define financial security by access to credit or by independence from it? Now, before you answer that, either to yourself or in the chat, think about your current behavior, right? There are so many people. So, if this is you, you would not be alone. There are a lot of people who are using credit cards right now for necessities, groceries, gas, paying, bills and things of that nature. Okay. So, if you don't define Social Security by access to credit, then that means that you are either preparing to be or you are independent from credit. Okay. And we need to be independent from credit. We're going to talk about that. The last question for our stewardship check in today: are you chasing short term relief or long term resilience? Are you chasing short term relief or long term resilience? And that's always a good question, because the majority of us, we are always looking for the short term answer, right? Even when we don't think or don't even know that we're looking for the short term answer, that's just kind of the way we are, right? We want to, what is the quickest, shortest answer to this problem? What is the quickest way out of this situation? And we are not thinking about how the decisions that we're making in the short term affect our ability to be resilient in the long term. All right. And so we have to make sure that when we are dealing with today's temporary financial challenges, that we are making room for the long term. Okay. So today's conversation is about clarity. Once again, this is not about panic. We don't do that here. Okay. We talk about some of the headlines, but then we're talking about how we're preparing for it. Okay. Not panic. Okay. That is not how kingdom citizens operate. All right. So let's get into our kingdom clarity segment. And I want to talk first about the credit card rate cap. The credit card rate cap. All right. So there's been a interest cap that has been proposed, right? A temporary 10% limit on the APRs on credit cards. And APR means annual percentage rate. Okay. Just for those who may not have known. So it's proposed. All right. Nothing has gone into effect. It hasn't been, voted on. We don't even know if this will even come to a place where it will get voted on. However, because there's talk about it in the news, we need to be paying attention and seeing how we prepare in case, right? So on the surface, this 10% cap rate on credit cards sounds good, doesn't it? I mean, yeah, it does, right? If you have credit cards and your interest rates are 28%, 29%, 30%, 32%, yes, this 10% sounds amazing. Okay. So lower interest so that consumers aren't ripped off. That is the story. Okay. That is the narrative. We're going to lower the interest rate so that consumers are not ripped off. But let me tell you something. What else is floating around in the news? And that is a comment that was made by a major financial leader. Okay. Jamie Dimon, I think it's pronounced, of JP Morgan Chase. Okay. He calls it an economic disaster. Now, why would he call it an economic disaster? Right? We have to pay attention to that. And some of us might be thinking, oh, that's because they won't, if it's lower to 10%, they won't make any money. Da, da, da. And that's part of the issue. But there's a little bit more to it than that. Okay. So here is the nuance. Here is what is not being touted in the news. And that is, good intentions doesn't always guarantee good outcomes. Okay? Good intentions doesn't always guarantee good outcomes. A 10% cap would protect people from excessive interest rates. Yes, it would. But it might also force lenders to tighten access to credit. Okay? That means they are going to be looking for people, because who normally gets the lower interest rates, y'all? Who normally gets the lower interest rates, right? No surprise. People with great credit, right, get the lower interest rates. And those who don't have good credit get the much higher interest rates if they obtain any credit at all. Okay. So experts are warning that banks could reduce credit lines, okay, which I believe that will happen if this credit cap goes into place. Number two, they can also restrict cards for people with less than perfect credit. And I believe that that would happen as well. It reminds me of when credit cards first became available. They were not widespread like it is now, right? Only, the people with great credit could actually get credit cards. And then some years down the line, it started to open up to other people, but that is because they were putting in higher interest rates and things like that. People with not so good credit, bad credit, get charged a higher interest rate because of the risk that that bank is taking on you. Okay, so the higher the risk, the higher the interest rate, right? Now, um, banks are also going to have to determine whether they're going to hike credit card fees. Are they going to cut rewards programs? They're going to have to do something, right? Because this is going to touch their pockets as well, of course. And this, of course, is also going to make access to everyday credit harder for the very people the policy intends to protect. Because this is real. Who is this policy protecting? Again, it is protecting the people who have 25, 28, 29, 30%, 32% interest rate. Okay. That's what this uh rate cap, that's who this rate cap is supposed to protect. But in the protection, right, it will cause others to, it will cause for them to not even qualify for credit to begin with. These are the things that could possibly happen. Okay. So fewer cards also doesn't mean more cash. So credit cards are often used, as I said earlier, as emergency buffers, right? They're not just consumption tools anymore. It used to be strictly consumption tools. People would just buy things that were discretionary with it. That's not the case anymore. So if credit becomes scarce, then people with very tight budgets may turn to predatory alternatives or lose flexibility entirely. And this is why the leader at JP Morgan Chase said that this would be an economic disaster. Okay. Now, how are we to look at this as kingdom citizens? Well, first of all, we must understand in any case, credit is a tool. That's it. It's a tool. It is not a safety net. Okay. That is not what it's supposed to be used for. So we want wisdom. We don't want to be able to rely. We shouldn't be relying on credit cards. If credit access shrinks, it is going to force people to steward what they have better. Now, to me, that's not a bad thing, right? It's not a bad thing. Um, e- it's not a bad thing. Okay, we may not like the way it goes down, but it's not a bad thing. And if they're forcing people to steward what they have better, that will align with the biblical admonition against debt slavery. Okay. Because a lot of people right now, because they have had access to credit and they probably should not have had access to credit, are slaves to that debt. Okay. Proverbs 22:7 says the borrower is slave to the lender. And that's true. We don't like to hear that. We don't want to hear it, but it is absolutely the truth. All right. So we're not rejoicing in the restriction necessarily, but what we are going to do is we're going to prepare for independence. Okay. So if you have been a person who has been um, dependent on your credit cards for not discretionary things, for your necessities, stay tuned because towards the end of the show, we're going to talk about what do we need to do so we can prepare. Okay. Now, I want to switch shifts. I want to shift topics. Okay. I want to talk about the markets and the Greenland NATO deal and what happened. Okay. So last week, markets were very volatile, right? After the news of possible tariffs tied to the Greenland negotiations. Now, what does it mean that the market is volatile? It means it's up, down, up, down, up, down, up, down, up, down, up, down. Okay. It's not moving predictably at all. It never really is 100% predictable, okay? But there are patterns that you can follow and say, okay, I'm seeing this, I'm seeing this is likely going to do this. Or based on what we saw over the last year, 5 years, 10 years, it has done this, and we can predict that it may do this, right? But when it's volatile, you really can't make those predictions. You just have no idea. So last week, the markets were volatile. And they were volatile because there was this talk about tariffs being tied to the Greenland negotiations. Well, we know that um, business owners right now are not fans of these tariffs. Okay. It is costing them more money to, especially if they have a product where they were sourcing materials from other countries, it is costing them more money. Now they cannot, some of the companies are like, we're not going to foot this bill all alone. We're going to either, pass this entire cost on to the customer or a large portion of the cost onto the customer or part of the cost onto the customer, right? So anytime there's tariff talk, it makes the markets go up and down, up and down, up and down, which is called volatility. All right. Investors also reacted sharply. Okay, so the stocks dropped as trade tensions escalated. What does it mean that the stocks dropped? Now, for the investor, that's a good thing because that means now that prices are lower, okay, per share. If something was $1,000 per share, now it might be $800 per share or something like that, right? Prices have dropped. It's a good time to buy. However, if you're looking to sell your shares, you don't want a volatile market. Okay. You don't want that. You want to be able to sell your shares at the highest point possible. Okay. And so, who would be um, people or a group of people where a volatile market would not work? Those who are getting ready to retire or are in retirement. Okay. They don't want volatile markets. They cannot afford to have their money be up and down, up and down. They cannot afford to allow for their portfolios to lose value. Okay. Now, that was last week. Yesterday, I believe it was, President Trump announced a framework of a future deal with NATO and he backed off the tariff threats. Now, when he backed off the tariff threats, okay, that sent the markets back up. Okay. And everybody's like, yeah. Okay. Not everybody, but business owners and investors, right? So that sent the markets back up very sharply across major indices. And when I say major indices, if you watch the news, you hear something about the Dow Jones, the S&P 500. That's what, okay, I'm talking about those things. All right. So, but why did the markets rally? Well, investors don't like uncertainty. Okay. And this is what I was talking about, right? When it's not volatile, you can't predict 100% what's going to happen, but you can look at patterns and things and kind of have an idea. Investors don't like uncertainty, especially when it threatens global trade and tariffs. When talk of tariffs against European allies was pulled back, okay, and a diplomatic framework was announced, the risk decreased and the markets then responded. Okay. So this teaches us two things. All right. One, the markets are driven by sentiment. And what do I mean by that? Emotion. Okay. And perceived risk, not just fundamentals. All right. But that's why I say that as an investor, a smart investor, because there's a lot of folks in investing, but they're not necessarily smart investors. As a smart investor, we We see, okay, we know the headlines can affect, the markets. We pay attention to that, right? But we don't make decisions and move emotionally. All right. We move according to strategy. All right. Number two, the number two thing that we learn, political events that reduce trade barriers are interpreted as better for corporate earnings. Okay. If you reduce the tariff costs and things like that, obviously that is more money that the business owner can keep in their pocket. They don't have to pass costs on to their consumers, right? So it's good for them, but it's also best for, well, it's not also, but it is best for the investor. Okay. In these situations, the investor typically is the one who wins out. Okay. So the world's money systems will celebrate, excuse me, the world's money systems are going to celebrate less conflict and more trade. Okay. But not because it benefits families first. See, this is what I need you all to understand, because everybody is always thinking, oh, they're trying to look out for the people, the ordinary Joe Schmoes. And, no, no. Okay. The, um, it's not going to benefit families first. It's going to benefit investors. Okay. So now if your family happens to be investors, okay, it's going to benefit your pocket. Okay. But it's going to benefit investors, and it's going to benefit corporate profit business owners. This is another reason. This is another reason why I am always saying, hey, we need to become investors. And hey, we need to own businesses. All right. And I know not everybody is cut out to be full-time entrepreneur and anything like that. But look, in this day and age, everybody needs some type of side hustle. Okay. So start your legally, start up a legal business so that you can capitalize on these benefits. All right. Now, what must we discern as kingdom citizens? We have to be able to discern what the headlines mean for markets. We cannot, and I have said this a number of times on a number of platforms, um we cannot get into the back and forth conversations. We can't get into the conversations about Republican versus Democrat, black versus white, whatever religion, all that. We cannot be getting into those um conversations. We can't get into the conversations about um, whether Venezuela was the right move. And when I say get involved, like we can have these conversations, but we can't be tied to those conversations. We can't be tied emotionally, right? People are out here, you can't be my friend because you vote different than me. And this is ridiculousness on a whole nother level. But for the markets, those are not conversations that we need to be so involved in at all. Okay. We need to be discerning, okay, what do these headlines actually mean for the markets? What do these headlines mean for my finances? Right? And where is God actually calling me to position my money? Those are the things that we need to be thinking about as kingdom citizens. All right. So, what does it mean for you practically? Like in my everyday managing of my money, what should I be doing? Well, here's how we should be responding as kingdom citizens. Number one, we need to make sure that we're protecting our income. All right. We cannot depend on credit. I'm not saying, everybody should just go cut up their credit cards and not have them or whatever. But if you are in a position where you are dependent on your credit cards, you have to work your way out of that dependency. Okay. If access to credit becomes tighter, right, because they decide they're going to reduce the interest rate cap, we need to make sure that we have cash cushions that are built. We need to make sure that we are um, reinvesting in productivity, rather than just consuming. Okay, so in other words, multiple streams of income, right? You need to be a producer, not just a consumer. And we also need to avoid relying on these cards for our essentials. Okay. This is practical stewardship. This is not judgment. All right. Because I know some people are like, oh, they're judging us because I have to use my credit card for blah, blah, blah. No judgment. Okay. None. If you knew my story, you would know I don't have judgment for nobody. Okay. So I am merely saying these are the things that we need to make sure that we do. We need to get ourselves independent of credit. Okay. Not that you can't have credit cards, but you should not be dependent on them. All right. Number two, position for cycles is what I call number two. In other words, well, in tandem with that, not chasing the headlines. Okay. So markets spike on the news, right? But cycles are real economic rhythms. So instead of making decisions for the short term, oh, this company, the price just dropped way low. Let me get $5,000 in there so I can buy up all these shares, right? Or, oh my goodness, the market just spiked way up high. Let me try to sell, a little bit of this or whatever, right? Instead of trying to time the market like that, you need to position yourself for long term growth, okay? Not the short term volatility. All right. And how do you do that? That means you are investing consistently in the market, whether it's up or whether it's down. But you have a strategy that is working for you, where you are investing consistently in the market. And in that way, you can take advantage of both the ups and the downs. All right. And number three, invest where fundamentals grow. Invest where fundamentals grow. Now, what do I mean by that? In times of uncertainty, capital often flows to a few areas. Okay. Energy, infrastructure, tech, and stable dividends. These are the four um, places, industries, whatever, that you want to make sure that you're investing in. Because even in times of uncertainty, these particular things are always needed. Energy is always going to be needed because we need gas and electricity and all of that and water and all that to run our households. Infrastructure, right? Because we're still driving on the roads, we're still having to use go to work in these buildings, all this kind of stuff, right? Tech. I mean, can you imagine our world without tech? Right? All the things that we do on a daily basis that include tech. And then, of course, stable dividends. And what that just means is that you're invested in companies who are consistently giving out dividends, and they have done so over a number of years. Okay. So that is where capital will typically flows to, right? Remember, we're to follow the money and strategize based on that. This is not blind chasing. Okay. This is disciplined research and kingdom alignment. That is what that is. All right. And then we want to build resilience. So, what does that mean? Um, we want to tighten up on our credit use, right? Get better at our cash flow, increase our cash flow, and get better at managing our cash flow. According with market headlines, we don't want to get caught up in the emotion of it all and the short-term nature of it all. We want to position ourselves for the long game. We do not panic sell. Okay. So if you hear an announcement, it's all, that's bad. And you're like, oh gosh, everybody is selling their shares in the market because they think it's going to tank. Well, it's going to continue to tank because everybody's selling shares. But we're not going to panic sell. That's not what we're going to do. Okay. We buy low, we sell high every time. Trend shifts. Okay. When we notice shifts, we are going to move with discipline, not simply because it's the trend. Does that make sense? Some of us like, oh, you know, this company is in right now, because this is a, I don't know how, what kind of trend can I think of? It's a million and one, but I'm trying to think of a really good example, right? Like, I don't know, but just let's just say, there's this widget that's created and it is a trend. Okay. It is a trend. That means it comes and it goes, right? And so we are not going to go, you know, latch on to every trend and invest, in every trend. No, we are going to move with discipline. All right. So the world's response to the world responds to fear and hope in the same breath. But a kingdom citizen, what we respond to is wisdom and obedience. The scripture says that for God gave us the spirit not of fear, but of power, love, and self discipline. 2 Timothy 1:7. So that means that we don't react like the world to the headlines and all of that. What we do is we respond with strategy that's grounded in sound stewardship. Okay. All right. So I hope that this episode has been very helpful to you. Make sure you tag someone or share this out on your platform, because people need to know this information. We need to know how to move financially in the season, out of the season, all the time, right? So let's get this message out. Now, next week, we're diving into retirement strategy for believers over 50 who have little to no savings. So if you are someone who is approaching 50, you are 50, you're over 50, you have little to no retirement savings, you definitely want to be here, and tag someone else who needs to be here next Thursday, okay? 12:30 Eastern. This topic is going to change the way that you view long-term planning. A lot of people are thinking that it's just absolutely impossible, right? That, you're done for, right? But that's not necessarily the case. Now, you may not be able to do 5 million, you know what I'm saying? But all hope is not lost, okay? And it's going to connect perfectly to what we've been talking about today. Now, if you want kingdom strategy for protecting your income, for stewarding wisely, and positioning for long term growth, not just reacting to headlines, then Financial Rebellion, my 90-day coaching experience is for you. Cohort 3 is starting March, first Tuesday in March. However, you need to get in long before March, okay? Like, you need to get in now, because they are preparing. We have already done a 14-day fast. They're taking their initial assessments. They have a book that they've been reading, my book actually, called Stop Begging God for Money. It's an award-winning book, by the way. We thank God for that. So they are reading that. They are doing and there's a few more things that they are getting ready to be a part of, to prepare for when we get started in March. All right. So you don't want to wait until just before the first Tuesday in March to start. No, you want to get in now so that you can be as prepared as everybody else. All right. In Financial Rebellion, we're going to walk through allocating power and how to budget within your allocations. We're going to talk about investing and investment discipline. We're going to talk about risk management. We're going to talk about legacy thinking. We're going to talk about so many things over those 90 days. Okay. You will not, your mindset is going to have a tremendous shift. You will not even recognize, like, wow, just a few weeks ago I was thinking like this, but now I have a whole new way that I think about money. And because you have a new way to think about money, your decisions, you're gonna make your decisions differently. You're gonna behave differently around your money. And therefore you're going to start seeing the success in your money that you have not been seeing in, I don't know, all your life, maybe. Right? Or, just having a hard time. You keep getting into these patterns, the same patterns over and over again. So anyway, the link is in the description. It is bit.ly/join the rebellion 2026. And it is still okay. I had said this was a super early bird price, $249, because it's originally $3,490. Okay. But in this season, if you've been following me, you know what season we're in. In this season, I've been saying that, okay, I don't want people to have an excuse. So it is only $249. And there is still payment plan. There are payment plans available even on the $249. Okay. No excuses. There are no excuses. All right. Now, if things are really tight for you and you can't even do the $249 right now, I get it. No problem. No shame, no nothing, right? Grab my book, Stop Begging God for Money. And you can get that on my website, authorlexijohnson.com. Okay. And if you need some personalized help, visit my website, mm4h.life, to check out all the other services I offer. And or you can also set up a 30-minute complimentary consultation. And that link is in the notes in the description as well. Okay. That's all that we have for today. We'll see you next week. We're talking about investing for retirement for those who are 50 and over and you have little to no savings. You want to be here next week when we talk about that. God bless. We'll see you next time.